cap rates are at their lowest levels ever right now for many major product types in many major metros, and at the same time, interest rates are rising faster than they have in years, with several more potential hikes planned in 2022 alone. And at times like these, real estate investors and private equity firms are trying to manage risk and taking specific actions in order to maximize their upside and minimize their downside in the case that the market decides to turn. So if you're a real estate investor or working for a real estate investment firm and you're worried about the market getting overheated, but you also don't want to sit on the sidelines until that day comes, in this video, I want to share 3 things that you can do to manage risk when looking for deals in a rising interest rate and record low cap rate environment, and how to narrow your search to limit your downside and protect your investment over the long term. So to put the state of the commercial real estate market into perspective, according to CBRE, stabilized Class A industrial properties in Austin, Texas were trading at anywhere from between a 5.25% and 6% cap rate as of the first half of 2018. But in CBRE's most recent report, stabilized Class A industrial properties in Austin were trading at anywhere from between a 3% and 3.75% cap rate as of the second half of 2021, which represents a 225 basis point drop from just 3.5 years ago. This means that a Class A industrial property in Austin generating $1 million a year in net operating income would have been worth anywhere from between about $16 million and $19 million in 2018, depending on which end of the range was used to value the deal. But at the end of 2021, that same property generating that same $1 million in annual NOI would now be worth anywhere from between about $27 and $34 million, resulting in a 60 to 75% increase in property value just from that 225 basis point drop, assuming 0 changes in operations of the deal during that time. And with cap rate figures even dipping into the 2s in some industrial markets and 3 to 4% cap rates in multifamily starting to feel like the norm, a continued rise in interest rates could mean some really big changes for commercial real estate valuations, especially in the product types seeing the lowest cap rates today. So for commercial real estate investors looking to protect their downside in the case that things do turn sideways, what are some steps that can be taken to make that happen without getting out of the game completely and without sitting on the sidelines for an indefinite period of time? Well, the first thing on this list is related to record low cap rates directly, and this is to look for deals that make sense financially immediately upon acquisition and deals that aren't heavily reliant on a major rent pop that you hope will happen at some point in the future. With interest rates on commercial loans having risen above cap rates in many markets across the US, this has led to some really tight going-in cash flow yields for investors that have bought properties using leverage on their deals over the past few months. For example, to run some basic math on this, if you were to acquire a property for $10 million at a 3.75% cap rate, that property would generate a $375,000 NOI in your first year of ownership. But if you were to use debt to acquire that property using a conservative 60% LTV ratio and a 4% interest rate amortizing over 30 years, the annual loan payment would come in at over $343,000, leaving just $31,000 in annual cash flow on a $4 million investment, which comes out to less than a 1% cash on cash yield with an extremely small margin for error within your operations. And if rents don't increase substantially after you buy the property in that type of scenario, it's very unlikely that your operating cash flow is going to get your investors to their target returns, and especially if interest rates continue to creep up and cap rates rise even modestly, you may not even be able to sell and get out of a neutral or even negative cash flow scenario that you may have gotten yourself into in the first place. And to be able to increase rents at all, renters need to be able and willing to pay those rents, and if the market turns and we enter a recession or see continued inflation in the high single digits, it's going to be hard for residential tenants to justify paying an extra $250 a month for things like quartz countertops or stainless steel appliances, and hard for commercial tenants to justify expansion with tightened consumer spending, higher lending rates, and increases in payroll costs to compensate their staff. So with this in mind, if you can find deals that pencil outside of the traditional value-add renovation model by creating value immediately through things like negotiating property tax reductions or abatements with the city, reducing operating expenses by renegotiating large contracts with vendors or property management firms, or buying a property right before a known contractual rent increase for commercial tenants, these things can all help to decrease your risk in the case that the market turns and rents stay static or even move backwards over the near term. Now, the next thing that's worth focusing on when looking for new deals in a market like we're seeing today is also on the operations side of things, and this is to stress test your rents based on your expense load per unit or per square foot, especially around your fixed non-controllable expenses like property taxes and insurance. States like Florida and Texas have become extremely popular real estate markets over the last few years, but these states also tend to have some of the highest property tax rates and insurance rates across the entire country, which can lead to a lot of stress on your operating margins in the case that your rents end up going south. Property taxes and insurance in these states can often make up 35, 40, or even 50% of the total operating expense load at a property, and unlike elective amenity packages or short-term contract costs, investors can't immediately pull back on these expenses if rents were to suddenly drop. And with relatively loose government regulations around new development in these states, supply has also historically been pretty quick to outpace demand in these areas, and if new product deliveries end up getting out of hand and rents end up dropping in these markets, even just a 2 to 3% increase in property taxes or insurance premiums can cause a huge strain on operating cash flow as a result. This is a case where commercial properties can often have an advantage over multifamily properties and hotels with long-term leases that aren't subject to short-term market rent fluctuations and operating expense reimbursement structures that can often shield the landlord from risk around rising property taxes, insurance rates, or other ordinary expenses required to operate the deal. Ultimately, taking a look at the expense load of a property on a per unit or per square foot basis, and then running the numbers to see where rents would have to go in relation to that figure to hit a break-even cash flow point or even go negative is going to be helpful in choosing the types of deals you want to go after and also the geographic markets that you want to target in this type of an environment. Now, the last point on this list has a lot less to do with operations and a lot more to do with the back end of a deal, and this is to look for new property acquisitions that you're able and willing to hold onto and operate over the long term. If you buy a property with the sole purpose of exiting that investment in just 2 to 3 years, in most cases, this means that you're very likely going to be heavily reliant upon your sale value meeting or exceeding your pro forma projections in order to hit your targeted returns. But if interest rates rise by another 150 to 200 basis points over the next few years and cap rates increase by even half that amount, a scenario like this could significantly lower your exit value and could force you to postpone your sale of the property even if that isn't in line with your original business plan. And going back to the first point on this list, if you go into an acquisition ignoring what stabilized operating cash flows are going to be after a renovation and you only focus on sale proceeds and where you're likely to exit the deal, if market conditions shift and you're not able to sell at the time you had initially hoped, buying a property that will also produce strong operating cash flow regardless of the timing of the sale is a key part of maintaining optionality even in the face of changing market conditions. In the short term, real estate values move up and down in cycles, but over the long term, US real estate values have historically continued to rise over time. So regardless of how heated the market might be today, if you can buy properties that you would be happy to own long term, whether that's a stabilized asset with strong fundamentals or a value add project that you're excited to own and operate even after a renovation is complete, if you can hold on for 5, 7, 10 years or more, you'll have a much higher chance of things turning out okay, even if the market does turn against you in the short term. So I hope this was helpful in getting a better sense of how you might want to go about navigating the commercial real estate market we're seeing today. And if you want to take a deeper dive into learning more about real estate investment analysis and how to create and use pro forma acquisition models to value new deals, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, industrial, office, retail, and mixed-use deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on deal analysis and finding real estate investment opportunities, make sure to hit the like button and let me know. And let me know in the comments what types of deals you're looking for right now and how you're finding value in today's market. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.